First, if you just look at what's happening today, the White House announced $50 billion, or I should say tariffs on $50 billion of Chinese imports. Yesterday, we know that Jay Powell, the Fed chief, declined to comment on what trade policy or a possible trade war would mean for inflation, for markets. Clearly, investors are trying to absorb all of this information, and we see stocks are falling, bonds are rallying. Give us your take.
Well, I think a trade war, and to the extent that the Chinese measures reflect that, are certainly not good for economic growth, and perhaps not good for inflation in terms of slightly higher inflation. So it's hard to know. The bond market may be reacting to the potentially slower growth, but not the potentially higher inflation. I think basically it's a push, and I really don't think the situation today in terms of Chinese trade is the reason behind the markets.
What do you think the reason is?
Well, I think investors heard Chairman Powell yesterday. They saw him as pragmatic versus academic, prior Chair Yellen and Chair Bernanke, and they heard him say basically that it was not a day-to-day, but a meeting-to-meeting type of decision. He said the one important thing that you can glean from today's statement is that we raised Fed funds 25 basis points. And yes, the green dots are up around 3% in terms of Fed governors and Fed presidents, but I think the market knows better. And my outlook refers to the possibility and indeed the probability that Fed funds have another 25 or 50 basis points to go, and certainly not another 3 or 4 or 5 hikes.
Speaking of Jay Powell, your thoughts on his debut, certainly holding the press conference, his first FOMC chair meeting. How would you grade his performance? A, B, C?
Well, the performance to me is not important, but you asked, and so I'd say it was very good. He's like I say, pragmatic and not necessarily pedantic. He doesn't follow models, it appears, as much as Yellen or Bernanke did, and to me that's very important because prior models by the Fed are a 20, 30, and 40-year type of look at an economy that doesn't exist anymore, and to the extent that Powell views that as the historic as opposed to currently relevant, I think that's all to the good.
Bill, flesh out what you were saying there about the apparent exaggeration of what the Fed can achieve here in a 2% inflation world. You're saying, actually, that interest rates can't get much above 2% without creating all sorts of problems. Just explain to us what you think the impact would be, whether it's interest rates, whether it's for other central banks or for the US dollar, if indeed they do go above 2%.
Well, I think it depends, of course, on other central banks. China just raised their short-term rate yesterday. But, it gets down to a question, in my view, and perhaps in Powell's view as well, of what the neutral Fed funds rate is. I think they're trying to find that out. The Fed calls it R star. I would think, and we're all just thinking, because the historical evidence would suggest that the new neutral real Fed funds rate should go back to 2% as opposed to 0 where it is now. But I think it's really 0. And so if we have inflation at 1 3/4 or 2% going forward, then I think Fed funds should be there too. But it's fair to say that some on the Fed think otherwise. And we're just going to have to see meeting to meeting. But I like that from Powell. He's going to look, and if unemployment goes lower but doesn't cause a wage increase, then look for 10-year treasuries around 3% for a long, long time.
But do you agree that actually the Fed can't say anything differently from what they are saying at this point? I mean, even if you're right in what you're saying and actually further out, they actually don't have the kind of scope that they're talking about, they couldn't indicate that to the markets and to investors at this stage, could they?
No, I don't think so. And yes, the Fed is always observing current circumstances, but even more so now when Powell suggests it's almost a meeting-to-meeting type of decision, and it's based primarily on wage growth as opposed to economic strength. So, investors and volatility will have to be dependent upon the week-to-week type of number, I suppose. But I think ultimately, if Fed funds rest around 2 or 2.25%, and again, that's not what the Fed is suggesting. But if it stops there, then a 3% 10-year Treasury is okay, and it's probably reflective of what I called a few months ago a hibernating bear market.
Yeah, you call that the current beast for the bond market as well. Speaking of beasts, that's a common word here in your monthly newsletter, your monthly outlook. You've identified leverage as a beast in the current environment that will come later. Leverage on whose part? On the government's part, or on government's part, on households' parts, on corporates' part? Can you explain that a little bit more?
No, I think a little bit in terms of leverage within the U.S. and of course the real problem, the real beast is in China and elsewhere. But in the U.S., in terms of your specific question, there's no problem, to my way of thinking, with leverage on the government side. They can always print money. They can always raise money. The problem is really not at the moment in terms of household debt, because household debt was reduced significantly since the Great Recession. It's probably in corporations and in zombie corporations that have been kept alive by very low rates, by floating rate notes, et cetera, and that now may have to roll them over in the ensuing months and years. And so we may see some high yield damage if rates continue to go higher, because they're the most highly levered.
Yeah, and I ask because household debt caused the last recession, was a catalyst there. How worried should we be about corporate debt causing the next recession?
I don't think it's going to cause the next recession. I think I would add to what I just said in terms of short-term rates that the yield curve is flattening. You talk about it a lot. Others talk about it a lot, mainly in terms of the Treasury side, a 55 basis point difference between 2s and 10-year. I would suggest that investors and recessionary lookers should look at the swap curve. That's a little esoteric, but the swap curve has flattened even more than the Treasury curve, and it's now around 26 basis points, which historically has led to a slowdown, certainly, in the U.S. economy, if not a recession.
Slowdown, not recession, okay.
Bill, a lot of this is just a case of whether it's the central bank or for us watching the data and just seeing how the economy plays out. And it's the same thing with where we started as well, talking about the prospects of greater trade tensions going forward. How should investors look at the markets overall today, and how should they be positioned?
Well, I think they should begin to position for slower growth. What are some of those signs? The Atlanta Fed, which puts out a weekly forecast for first quarter GDP, suggests around 2% as opposed to 3 to 3.5%. We have a savings rate, consumer savings rate of 2% versus a normal 6%, and so there's not much oomph to come from consumers going forward if they don't get wage gains. And we've had a central bank raising interest rates now for some time, perhaps 150 basis points, and the curve flattening. And so these are all potential symptoms of not a recession, but certainly slower growth, and maybe equities are starting to realize that.